Welcome to FX Options University, recorded live at the International Securities Exchange, the world's largest equity options exchange. Join the industry's top trading professionals as they provide insight and strategies for trading in the currency markets using FX options. FX options are a low-risk alternative to hedging currency moves in any market condition.
Good afternoon, everyone. Thank you for joining us for today's webinar. Today's session will be hosted by Al Brinkman, who will be teaching us about ratio spreads and ratio backspreads. These are leverage option strategies using ISE FX Options. Al Brinkman is the principal of Brinkman Group and an education consultant with many years of experience in the trading world, having spent 20 years as a member at the Philadelphia Stock Exchange as an equity trading specialist and option floor broker. He's also a staff instructor for the Options Industry Council, conducting option education seminars throughout the United States. We're excited to have Al back for another session, so without further ado, we're going to go ahead and turn it over to Al.
All right, thank you very much, Katrina. I hope everybody can hear me okay, and I'd like to first take the opportunity to thank all of you for taking the time out of your busy schedules and on this beautiful day here in South Jersey. To spend some time with us, and I hope the information that we provide is helpful to you in taking a look at ratio spreads and ratio backspreads, and just getting a feel for what they're all about here is what we're going to try to do. They're one of these things, just like any of these other option strategies that we talk about, that do take a little bit of work and a little bit of time to work through and get comfortable with. We are going to use them in the context of ISE foreign exchange or FX options. And in that, the way I'm going to approach this is the strategy is the strategy, whether we're using FX options, equity options, or index options to execute it. We'll go through that part of it, but we'll touch on the unique things I think that need to be kind of kept in mind when you use for an FX options trade. And part of that will be a little bit of a review, because I'm not sure, once again, how many of you have regularly traded FX options, are familiar with all of the different little nuances that FX options bring to the table as opposed to just regular equity options on that. And I'm going to try to move my mic. I see an echo. I'm not picking that up on any feedback that I'm getting, so we'll see how that plays out on that. So without further ado, we'll get started here, and we'll move through. And obviously, we'll start again with the standard disclaimers. Options involve risk and are not suitable for everyone. And I think you're all familiar with the characteristics and risks of standardized options. If not, that will come to you if you're about to open an account to try to trade options if you're new to the game. And then a final disclaimer from the ISE. Basically, I'm an independent contractor working with them. We're not doing any recommendations here. Nothing's to be construed as a recommendation to trade any particular trade or anything like that. This is purely educational. As I said, we want to cover the basics of these particular leveraged option strategies. So, an introduction, ratio spread strategy. Well, when we do the ratio, when we put it together, because there's different numbers of options bought and sold as part of the strategy, we have leveraged the leverage, which the option, of course, brings to the table. But it increases our profit, and unfortunately, it increases the losses as well, because we have that. We're going to talk about two primary ratio spreads here, one called the back spread, where we buy more than sell, and we end up net long, and then ratio spreads, where we're selling more than buying, and we're net short. In a ratio spread, obviously it will be a ratio sold or purchased, and it's usually done on a 1 to 2 or a 3 to 3 basis, depending on the spread, and that's what we're going to use today just for our illustration. So ratio back spreads. They profit when the underlying breaks out the upside or the downside, and losses and lose when the underlying remains stagnant. So they are somewhat of a volatility play in the sense that we're looking for a sharp movement. And we have to temper that a little bit. Whereas the last one we did straddles and strangles. When we did straddles and strangles, our volatility was we're looking for a volatility breakout, but we didn't particularly care. With the ratio back spread, we're looking for increased volatility to increase, our call values, our option values, if you will. But in this case, we need to have a specific direction in mind. We'll get more into that as we unravel, the basic strategy. The call ratio backspread, credit spreads, but they retain substantial profit potential of what we would call the debit volatile option strategies, and of course, straddle and strangle or debit volatile option strategies, if you will. So credit backspreads, such as the short butterfly and short condors, provide limited profit potential. The difference here with the ratio backspread, it has a limited upside breakout potential, and as we'll see as we go through, limited profit potential down to the odd side. And this is strange but true. The bull call ratio backspread, which is quite a mouthful, can, under certain circumstances, make money if the underlying moves in the exact opposite direction that we expected it to. And once again, as we go through the examples and talk through it, you'll see how this works out. Digress for a moment, like we did last time when we were talking, those of you that were with me, when we talked about using the straddles and strangles for, or with ETF options. We're going to digress a little bit and talk about FX options, the ISE FX options, and things we need to think about in entering spread trades. Fundamentals. And I apologize to those of you that are familiar with these options, but I think it is important just to reinforce some of this again when we go that way. The FX option, the ISE FX, allows you to trade the value of U.S. dollars versus a particular foreign currency. When you think about the U.S. dollar, you think about it two ways in the currency market. Is how many U.S. dollars or how many U.S. cents do I need to buy 1 unit of a foreign currency? So how many U.S. cents or dollars does it take to buy a euro, buy a British pound? Or the flip side of this, if I have 1 British pound, how much U.S. dollars and how many U.S. cents will I receive for that British pound? And of course, we always run into this when we travel overseas. We buy the euros going in, and we sell them coming out, and there's usually a big bid offer difference in that in that transaction anyway. Cash market traveler anyway on that. The ISE currently lists FX options on what are known as in-currency pairs, and that's that situation of U.S. dollars versus a particular currency. And they also offer what is dual per U.S. dollar or in U.S. dollars, which I just talked about a moment ago. How many U.S. dollars do you get per pound, and how much U.S. currency will I get for 1 pound? And that is available on 4 pairs, and that's primarily because of the way the currencies are quoted in the cash spot market, the underlying market for the foreign exchange, and that's where you judge the underlying from the FX option. So for an example, for a U.S. dollar euro contract, 0.6954 euros, or if we flip it over to euro U.S. dollars, it's 1.4380 euros. It's nearly a reciprocal transaction. Six major currency pairs. This is an important thing to keep in mind. These majors are they're the most traded. They have the most volume in the spot market, and that usually does in fact translate to the most volume in the options market. Well, so it's euro versus the U.S. dollar, versus euro, yen, Swiss franc, Aussie dollar, British pound, and Canadian dollar. They're the 6 major. ISE also offers options in the New Zealand dollar, Brazilian real, Mexican peso, and the Swedish krona, which clearly are currencies that are always pretty much in the news, particularly now. Mexican and especially Brazil are in the news a lot, and people do look at trade currencies. You do have some movement, volatility, and so the options make perfect sense to have them available for trading. In trading FX options, you apply the same trading strategies you would use for any equity or index option product. So if you want to use straddles or strangles, you serve 10 FX options, bull spread, bull call spreads, pair spreads, verticals, calendar spreads. Everything is available and can be overlaid with the currency. It's just that you need to, once again, be comfortable with understanding exchange rate movements and what goes into the analysis of that as opposed to equities or even an index, okay? A little bit of the difference here for the FX options. They trade from 7:30 a.m. to 4:15 p.m. They always say New York time, but they tend to say Philadelphia time where I am. That's okay. They are spread tradable as well. You can enter a spread and trade it as a spread that way. Important part of this is they are OCC cleared instead of just like the equity options. So you've got all that security built right into that. So they offer you the ability to step in there and trade a view of the value of the US dollar versus that of a foreign currency. Certainly a lot in the news these days. Certainly worth spending some time on. If you're not familiar with it, to look at it as another opportunity to get into a different type of market. Because you are now looking really in much more global economic and geopolitical terms. You may be looking at our regular equity markets, looking at an industry, for example, or something like that. So you can trade these economic and geopolitical world events. You need to get a good feel for them because they're certainly different. There certainly are a lot of that going on today, with everything going on with the euro. And that's sort of something out there today with the European market. And our tight prices and everything going over. Another way to use the currency option, we're not going to talk about it today, of course, is hedging a currency exposure should you have something that puts you at risk for an exchange rate change in that case. And you want to play if the dollar is going to appreciate or depreciate in value versus foreign currency. I won't get into the discussions on that. A lot of people have a one direction opinion on that. And this type of spread might actually work for that. Important thing to note, the trading in these FX options are available for broker-approved options account. I believe you will have to get specific permission for trading FX options, but it should not be an issue because they're very comfortable with them in any of the brokerage firms today. So they're easy to do. If you're a trader, approved for options trading, this is just a mere formality, but I do believe that you do have to ask for approval to trade them. They offer price transparency, great regulated environment, fully electronic order execution, and market volatility. All in all, a great marketplace to get into. Let's talk about these in the ratio spread context a little bit. What you need to do is we're looking at volatility and we're looking at price action. One thing that you will probably start to notice is when you're getting into FX, and here I have in the FX options, you'll notice that the volatility or the implied volatility will, on balance, be lower than you see in the equity options market. And that's just a function of the marketplace to a degree. And you need to keep in mind that isn't necessarily telling you that there's no volatility in a move. Just remember, move from let's say 10% volatility in a currency pair from 10 to 17% is a significant move. Whereas sometimes in the equities you can see incredible numbers, 20, 30%, that type of thing. So once again, it doesn't preclude significant underlying price move. So it doesn't remove the FX from this strategy where you need a big move. Okay, because that volatility number is a little bit different to you. One thing to keep in mind, FX cash or spot quotes, these 4 digits are called tips or price interest points, right as a decimal point. Below in the example, you see 135 cents, 135 T. And quite honestly, a lot of movement out here takes place back in that number out there. Sorry. Marker. Out in that movement, and you'll see it. And actually, you can move from 135.10 to 136.10, for example. One full figure, as they call it in the currency market. That's a fairly significant move. And that comes into play when you're looking at strike price. We'll talk about that as we go further through the strategy. One thing about foreign exchange, the exchange rate, it tends to be trend-oriented. Okay, and they continue over longer periods of time. Significant why this strategy is a little bit longer than you might be being on the spread for longer periods of time. You need a significant move, therefore you need a significant trend. And FX lends itself very well to that scenario. It doesn't mean that you're going to have strong daily price action. We'll call it speeds break out large parts because we'll be moving sharply intraday in the currency markets, and that really has become quite common, but it still tends to stay with the trend, if you know. Anyway, so there we go. Recommended for the longer time frames. We're going to talk about backspreads. Now making an FX option ratio spread. Ratio spread is a shorter time frame than the back spread. Back spread we're moving out in time. Ratio spread, plain ratio spread, we're condensed that frame for a while. So now you're subject to significant daily movement in your options position and in the price of those options. So this is a little bit tougher psychologically, because you got to tough it out a little bit. When you trade, it starts out, and all of a sudden, because you have some sort of anomaly in the day trading of the underlying, it looks like it went bad. But you've got to, again, your research, your feel for how you want to play this. It's going to do it. FX options in general, review for volumes and open interest like you would ETF options, just like you would equity options. It will probably be concentrated at the money near month, like everybody else. If you move out some time, they will probably tail off. But I would use kind of as a baseline, what are they doing in the near month? Because that's the volume that's going to increase on that. I would recommend that you consider, especially if you're starting out with this, stay within the 6 major currency pairs because of what I mentioned earlier. That's where the volume in the underlying is concentrated. Therefore, that translates to volume and open interest in the option product. Now, the other currencies, if you look at them, bid offer spreads are a little bit wider, but look at price action you see in this. The trend has these sharp movements and stuff. But here again, that underlying liquidity and liquidity in the option may dampen that opportunity because you may end up having to put the spread on strike price intervals further from the buy and sell, being a little bit further apart. Get the trade set up. And this will start right from the ISE FX Options.com site. If you're not familiar with the site and everything, it is kind of the be-all, end-all. They've done a marvelous job in putting together trading tools, commentary, educational stuff in there. They have a great series of webinars on FX options for just a whole broad swath for different strategies and different ways to trade these and things to think about. The reason I put this here was this mainly, not to mention the fact that it is a great site to use, but I wanted to make sure you take a look at these numbers. And although recently these numbers are higher than they've been over time, they're still probably not all that comparable to some of the more popular equity options we trade out there as far as implied vols and still on the lower end, although they're certainly not insignificant. All right. Enough with FX options. We got this set up and all. And let's see here. Okay, we're going to get into the defining examples of ratio backspreads and ratio spreads right now. We did that little spin up on the FX bit. A couple of questions here we have to talk about. The best pairs for spread trading, once again, I'll go back to what you mentioned. Stay within the 6 majors to get started. If you get more comfortable and you feel good with this type of strategy, and the research kind of indicates a good way to go, then I move into the other 4 perhaps. 6 majors are where the volume is going to be. Market testing FX options is pretty liquid. As I mentioned, they're going to see the liquidity up front at the money. By and large, because that's where most people are going to trade them, and most people trade options in general. So when you look further out, what you're going to have to do for ratio backspreads, you're going to be looking over a time period. You are going to see a drop-off there. But I would use the front month as a gauge where it will be as you approach expiration. That makes sense to me. I wouldn't want to say, well, geez, I won't do this backspread because volume liquidity 6 months out is very, very low. If it's very good up front, that's where it's going to be moving to as you go forward. That's when we're going to take a look at it. So let's introduction to the call rate back. What does it feature? A timed or a capped risk? It has substantial reward potential. I really do not like to use the word unlimited potential. That's just a personal thing of mine. You see a lot of people who use that. I like to say substantial. Because we do have an option expiration out there. There are some other factors you need to be aware of. It does require increasing volatility, and it does require you to be extremely bullish on the underlying. Okay. It is the strategy that I feel strongly, and I think a lot of my colleagues do, is for more advanced option traders, because there is a little bit more going into it to determine the strike prices and that sort of thing. And I also think there are alternatives to just that might be a little bit easier to manage. It is, however, good if you're risk averse, because you're going to know your maximum loss before, and once again, in most strategies, the spread type of thing, pretty much going to define that kind of what not always the case, but it does for the most of the call ratio back spread. Now, provide greater leverage than just running the underlying. Let me stop for a minute here. Once again, we'll slide into the FX realm. Not sure if any of you trade in the cash market in the FX industry, in the spot market. That's off exchange trading. You'll hear a lot of people talk about leverage in the cash market. I do believe that leverage has come into an area of you could get a 50 to 1 leverage spot FX. Used to be higher, and it may be higher in some other currency, but I do believe that has come into around 50% leverage, which is significant. There's no question about that. We've had significant 50% leverage sums. A good thing if it goes in your favor, and a bad thing doesn't. And you have to rely on a lot of very close-in stops. And daily FX trading is subject to price action during the day. It really does slight swings. You find yourself stopped out very, very quickly out of a trade because you protect the stop in, which you should do. And be out of your trade, and then find out that you're actually right on the turn of the currency. The option takes that away. I mean, it takes that out of the equation. You make the decision what you want to do, on moving out of the option, somewhat of the interday. So anyway, that's my soapbox on my options as a cash trade. Good degree. Anyway, trading steps. The call ratio back. Here we go. We're very bullish on the under. We're kind of bullish. Not going to work. We need to be really bullish. And the strange thing here, however, is our greatest stock to the curve. If in fact the underlying does move up, once again, we'll show you that in an example. We want to be sure we see a clear, strong uptrend, but we also want to make sure we've got a clear area defined for our underlying. As we get down to that clear area, we're going to decision make time. As I mentioned, options have decent liquidity because the cost factor will impact our profitability. And in the call ratio bracket, we need to give it time to work. We're going to look out about 6 months to do this. That's a fairly long period of time. You got to develop a comfort zone if you want to go out that far. I think we might want to possibly come in, but I'm just saying, let's use 6 months as a window out there, and then think about coming in. So we're going to sell 1 or 2 lower strike calls. We want to be around the at money. You're going to need to use an online calculator to find an optimum level. You need to go to do some what if scenario. If I use this one, if I use that one, what does it do to my break-even points? What does it do to my profitability? To do this, as I mentioned, these we tend on the spread. We're going to buy 2 or 3 higher strike calls. We sell 1. We're going to buy 2. We sell 2. We're going to buy 3. Okay. We're going to do 1 strike higher, and that. Sorry. Anyway. Sorry about that. I didn't catch. Sorry, Katrina. On that. They're all going to have the same expiration date. The ratio, as they said, 2 to 1, 3 to 1. We want to execute this at no cost and net credit. If when we're messing with strike prices, you're unable to get it even or for the credit, we probably need to go. We need to go elsewhere. We're going to back to the other one. I'm going to sell 1 lower strike call, buy 2 higher strike calls. All right. Now, once again, flip back to FX options in this scenario. FX options are at half point strike. So we have 124, the 124 and a half, 125, for example, 125 and a half. Now, right. You're going to have to do the math on if this works out for you. You may have to move that out just a tad more to get a little bit more separation and to be able to get to where we want to be. Bottom down here is no cost to the net credit.
Thank you for participating in this week's session. Please join us again next week. Get trading ideas, exchange rates, webinars, news, and commentary. Visit www.fxoptions.com. ISE FX Options can be easily traded through all options-enabled brokerage accounts. These exchange-listed securities are cash-settled in U.S. dollars and have a European-style exercise.